Hello, my name is Joshua Jones, and this is my Savvy Coders Bootcamp Capstone presentation. I chose a financial topic because I'm knowledgeable of the subject matter and my degree is in finance. I got my data sets from the Bureau of Labor Statistics and the St. Louis Fed. The St. Louis Fed's where they hold all the Federal Reserve statistics. The agile mindset was really key here for me because I had to switch topics a couple times because the other topics I chose had a lack of data. And yeah, so my initial question was, or my hypothesis rather, was that inflation. So I measured inflation with the CPI, the Consumer Price Index, and GDP will be positively correlated. I also believe that there would be some correlation between GDP and interest rates. And finally, I thought that mortgage rates would move in tandem with the Fed funds rate. And these are my assumptions, so I figured I would dig into the data and explore it and see if my assumptions panned out. Okay, so what do these terms mean? Just a quick overview. GDP is gross domestic product, and that's the value of all goods and services produced in a given area. In our case, we're doing the entire United States. The CPI is the Consumer Price Index. This is what economists use to gauge inflation, how much prices are increasing or decreasing for goods and services. Fed's fund rate is the rate at which banks can borrow money overnight. Interest rates are based off the Fed funds rate plus a certain percentage because banks are in the business of making money. And for our mortgage rate, we use the 30-year mortgages. That's kind of the standard in the mortgage industry. And going forward through this presentation, um, you'll hear me using the terms CPI and inflation interchangeably and Fed funds rate and interest rates interchangeably. Okay, my first and longest step was the data wrangling and cleaning in Python. It was kind of difficult because I had to do a bunch of calculated fields. As you can see at the top there, I was doing a calculated field. And there was a lot of direct assignment. And I figured out something cool. It was a bit of a challenge. Was you can see here that there's a warning when you try to assign things a certain way in Python. Like if you don't assign them with the iloc or loc, like if you just try to do a column assignment, Python will throw a warning, and because it thinks that's a slice of the data frame and not the actual data frame. So I figured it was best practice just to do direct assignment. So you can see here at the bottom where it says loc and date. That's where I did the direct assignment. You can also see at the bottom here that these are some of my more advanced group bys. Um, instead of putting stuff on one CSV, I kind of just I put some stuff in one CSV, but then I exported it as certain things I exported just as a series. And I did my initial cleaning in Python. That's where the bulk of it happened. Then I moved it over to SQL. So what you're seeing here is the database that I created in SQL with all my clean data. Here's an example of some of the queries I ran. So what I did is I made this database and then I did additional queries to clean up the data, remove some nulls, and kept only the columns that I wanted to keep. And then that way I was able to create the charts I needed without having a bunch of extra stuff in there I didn't need. Okay, so here's our first chart. We have on the bottom the GDP of the United States from 2000 to 2023. And on the top, we have the GDP growth rate per year and the CPI per year. And you can see it's reasonably correlated. One key observation here is that just in 2020, in our most recent memory, GDP spiked, but so did consumer prices. And we've all been in the grocery store recently, so we can relate to that. On our next slide here, we have the GDP growth and the GDP yearly growth and the yearly Fed funds rate. You can see the colors up in the legend. So not a whole lot of correlation going on here that you can see from the chart. Okay, here we have the mortgage rate and the yearly Fed funds rate. So I was really expecting the Fed funds rate to be more stable than the mortgage rate, but the variance in the Fed funds rate, it's going between 0 and 8%, but mortgage rate over time is sticking between 2.5 and 6.5. So you can also see down here where they were keeping the Fed funds rate really low. Okay. I did this as a quarterly chart as well, just see if anything looked different. It looked more or less the same. And then here's kind of the chart where the rubber hits the road. It turns out that the Fed funds and the mortgage rate, like I assumed, are super well correlated, almost a one. And then we have the GDP and CPI correlated close to zero point 0.7, which is considered a strong correlation. Not terribly surprising, as you would expect as GDP grows based on economic theory. As GDP grows, that inflation is going to move with it because there's more money in the economy. So, but the one that did really surprise me here was the moderately positive correlation between GDP and interest rates. Initially, my thought where it was that once interest rates go up, the GDP would go down, and that still may be the case. But I think what we're seeing the correlation here is because the the Fed is using interest rates to kind of curb GDP growth, so they're kind of going up together and then tapering off. But this is a good investigation point that I'd like to explore further. And on that note, future iterations of this, as I just said, this is a this is a moderately positive correlation that I'd like to explore further. And I'm not entirely sure what's happening there. I would also like to compare this data set to similar data sets, for example, like to like, so rich countries to rich countries, and maybe even third world countries or something like that. As far as lessons learned here, I think knowing and understanding statistics is paramount for this. I um, I calculated my yearly GDP by using the fourth quarter GDP, which was calculated as rolling, and then the St. Louis Fed just did yearly a different way. So kind of knowing that those kinds of measurements and how to correlate things and how to analyze things properly will help you avoid measuring errors, which it doesn't seem too bad initially when you think about it, but an error for United States GDP could, even just a small fraction of a percent could be billions of dollars. And that's about the end of my project. Thank you for the course. It's been a pleasure, and that's all I got.